Morning, everybody. I'll start the meeting off today. Thank you, everybody, for coming. As Cambridgeshire is the authority holding the position of Vice Chairman for the Management Committee for this current municipal year, they are now due to hold chairmanship for the Finance and Audit Subcommittee for the municipal year to June 2026. Members are recommended to appoint Councillor Robin White as chairman. Please can someone nominate Councillor White for this position of chairman of the ESPO Finance and Audit Subcommittee? Councillor Garland. Can I have a seconder, please? Councillor Bridgewood. Councillor White, you've got the chair.
Okay, cool. Welcome to today's meeting of the ESPO Finance and Audit Subcommittee. This meeting is being broadcast live on YouTube and it will also be available after the meeting. Can I please ask that all members and officers have their microphones on mute until we wish to or are invited to speak. I need to let you know that we are not expecting a fire alarm today, so if one does sound, please use the stairs and leave the building and convene on the field opposite to the visitors' car park. Please follow our Democratic Services Officer. We have received apologies from Councillor Jane James from Norfolk and Councillor Mohammed Jamil from Peterborough. Okay, our first item is the minutes of the meeting held on the 12th of February 2025, which are pages 3 to 8 of the agenda pack. I propose that the meetings of this meeting held on the 12th of February are taken as read, confirmed and signed. May I have a seconder, please? Councillor Bridgewood, thank you. Okay, I'm going to pass that by affirmation. Item 3, declarations of interest in respect of items on the agenda. Do any members have any interest that they wish to declare? No, cool. Item 4, there are no urgent items. I've had a request by officers that the order of the agenda be amended and that we will take agenda item 6 first. Can I please have the agreement of the members? Good, cool. All right, so item agenda 6 is the Internal Audit Service Annual Report 2024 to 2025, pages 21 to 42 of your agenda. Neil Jones, our Head of Internal Audit and Assurance at Leicestershire County Council, will introduce this report. Over to you, Neil.
Thank you, Chair, and good morning, members and officers. And firstly, thank you for allowing for the agenda items to be swapped. The reason being that obviously there's only 2 meetings of this subcommittee each year. So we have a planning meeting then and a sort of annual reporting meeting for audit perspective. So we're looking back at the 24-25 year before Matt then starts talking about the current 25-26 years. So sensible to have it in this order first. As we're the Servicing Authority, Leicestershire is a Servicing Authority. Obviously, I'm the Head of Audit for Leicestershire, so I'm also the Head of Audit for ESPO. And we produce a plan, you'll see in the February meeting, where we implement a plan with audits we're going to conduct throughout the year and how we're going to report on those. So, excuse me, so in paragraph 4, it explains that, I'm not sure how much members know about internal audit, but we have to work to standards. And the standards that we worked to during 24-25 were known as the Public Sector Internal Audit Standards. And what they require me to do is to present an annual report to ESPO. And it's that they require it to be reported to the board, which is effectively the Audit Committee. And this has been denoted as the Audit Committee, obviously. And the terms of reference for this committee allow the subcommittee to formally approve the report. So paragraph 5 explains there are specific requirements to incorporate into that annual report, but I think the most important for me is, it's my opinion, the overall opinion on the adequacy and effectiveness of ESPO's control environment over the previous year, 24-25. And the control environment is defined as the frameworks of governance, risk management and internal control. I mentioned that in 24-25 we were working to the public sector internal audit standards. They've changed from the 1st of April. So we're working to new standards on this year. I'll bring a report to the February committee about how they're going to be implemented. So in terms of how I've reached the opinion this year, if I might ask members to turn firstly to Annex 1, which is found on page 31 of your pack. And in that, I explain how I use a combination of evidence to reach the opinion, including the findings of audits which Matt and his team have conducted, and they're summarised in Annex 2. I also take into account and evaluate the control environment through for instance, attendance at this committee, attendance at management committee, so you can look at the associated governance arrangements and also policies and procedures. So in terms of an annual report, whereas individual audit engagements provide what is known as micro assurance, the overall head of internal audit opinion is macro assurance, so it's looking at the whole scope of things within the ESPO's control environment over that year. So I bring all those threads together and then produce an overall opinion. What I've come up with an opinion this year, again, is a definition of substantial assurance in terms of ESPO's control environment, which has happened for the last 3 to 4 years, if not longer. And what I've looked at the Institute of Internal Auditors definition of substantial assurance in that sense, and it's just for definition for help of members. That means there's a sound control of framework of control, that's effectively mitigating key risks, and it's contributing to the achievement of business objectives, and that's backed up by work that we've done. So no audits were classed as partial assurance. There were no high importance recommendations, new high importance recommendations, which is very good. We've got the occasional medium risk rated weaknesses, which is not unusual, and they're identified in the individual audit engagements. And then most importantly as well is if we do identify any improvements, weaknesses, that management then does react to those and helps us to put things correct there afterwards. So that's a positive in terms of management's attitude to resolving identified issues. So in terms of the opinion itself, it's listed at the bottom of page 33 in bold, and that's repeated throughout the documents in a number of places. We do have a caveat about an internal audit opinion that we obviously can only provide a certain scope of work over the period of the year. So that caveat is, we can only give an opinion on the areas that we've looked at, and there may be something in the background, hopefully not, that might cause issues in the future. So in the main appendix, which is page 25, that is actually the annual report where I've spelled out the requirements of that. So starting on page 25, so after some background, I'll repeat the opinion into page 27, and then through paragraphs 19, I provide sort of summary context, explaining that we conducted 10 assurance audits last year, and each of those received substantial assurance ratings, which is very good. And then we're 6 what we call advisory type audits. So that is where we are helping to review and implement control changes and projects. So we did 16 pieces of work like that. We also then did 2 audits which have spanned the 2 years, so they will be concluded in Matt's 25-26 reports. Paragraph 16 and 17 briefly outline how the service has performed in terms of the throughput of work. Paragraphs 18 and 19 reflect the internal workings of the service. So this is a general requirement for internal audit to have a quality assessment every 5 years, external quality assessment. So we had ours in the spring of 24, and it came out with, and we always have a chuckle about this, it came out with a rating of generally conforms, which is the top rating. So it's not very helpful in terms of the way that's worded, but that's a top rating. Some improvements to follow from that. We're working through a plan of improvements, and that working through those in line with the requirements of new standards, etc. And then finally, in terms of before I conclude on the report itself, a reminder, I think on today's agenda, you've got the annual governance statement. So part of my role and responsibility in terms of providing the annual report is to also look back and say, is there anything that I've come across that should be reflected in the annual governance statement? And there's nothing to report on that for this year. So overall headlines, and these are in the cover report. Again, overall positive opinions over the 3 components of the control environment. That's governance, risk management, control. An overall substantial assurance rating, and that the control environment remains adequate and effective. The majority of planned work was achieved. There were no new high importance recommendations. The service itself continues to form to standards, and I wasn't aware of any internal or any governance issues. What I do is I share this report now with my colleagues as heads of audit in your constituent councils. So they can then place reliance on that then for their work in their internal audit perspective. That's all I've got to say on the report. A very positive report. So I'll take any questions if any members want to.
Thank you very much, Neil. Does anybody have any comments or questions? No. I have. Oh, sorry. I thought you shook your head. Councillor Garland.
I just realised I think I did the whole without putting my microphone on, so apologies about that. It's comparable, which is good given the risks and issues that are around in today's society. To keep a good control framework is tantamount to the management and the help that they provide through the audit. So comparable.
Okay, thank you. I have one question. In paragraph 16, page 28, you've listed that you completed 16 planned audits, but you'd hope to do 19. What were the 3 incomplete ones? Page 28.
Okay. They're the 2 audits that span the 2 years, which I've covered off. Just bear with me. 2 audits that span the 2 years.
Rebates.
Rebates are spanning 2 years, and
it's on page 15, Neil, I think. Rebates, procurement and value for money, are those? You look on page 15, there's three audits that cover 2 financial years.
Sorry. Just put me on the hook there. Oh, did I say 2? Sorry, I said 2. There's rebates, procurement, and value for money on benchmarking.
Yeah.
But I don't think we'd actually started anything on the benchmarking.
We started interim work, but we're carrying on this financial year.
Right, okay, so it's basically just they are planned and they're in progress rather than they just haven't been done. Okay, I get it, that makes sense. Thank you. If you want.
It's a your external auditor has a defined deadline when it stops its work, and it has to produce the accounts from that. And that's why internal audit work it tends to be more fluent. So it can go over 2 years. Obviously, we don't want it to go over for a long time. We want it to conclude over. But there is that sort of, we make a decision in terms with Christian and in terms with Simone. Towards the end of the year, should we start that work or park it? And if we start it, then we obviously carry it over and we account for that in the plan in February. When you see a plan in February, that we've got work carried over effectively.
Thank you. I think I understand that. Okay, any further questions? That looks like a no. So I move that we approve the Internal Audit Service Annual Report for 24-25. Do I have a seconder? Councillor Bridgewood, thank you. All good with that? Cool, motion passes. Now we go back to agenda item 5, which is the Internal Audit Service progress against the 25-26 Internal Audit Plan at pages 9 to 20 of your agenda packs. Matt Davis, Audit Manager at Leicestershire County Council, will present his progress update. Matt, over to you.
It's not working again. It doesn't help that you can't see it when you're full on. You can't actually see the red microphone on the back. So. But not to worry, we've got there. Yeah, my role is the audit manager responsible for putting the team in to deliver the audits. So and then reporting back to Neil as head of audit. So just for the benefit of new members. So its progress, as it says in paragraph 4, its progress against the 24-25 plan. sorry, 25-26 plan, which also incorporates legacy work from 24-25. So as you mentioned earlier, the three pieces of work that we're doing in this financial year. It was a good question raised actually, because we did have a decision to make whether we actually carried them forward, carried on with them, or actually didn't do any of the work, and we decided that they were all important enough to carry forward and to do the piece of work and then complete the piece of work in the next financial year. Two of them were made easy, in as much as we've gone quite a long way into the actual piece of work already. So it was just a case of concluding the testing and then writing up. It's the plan that was approved by this committee on the 12th of February, and I know members weren't here for that meeting, but it does go into a lot of detail, that paper does, as to how we formulate the plan and the work involved. And obviously this time next year, in February, we'll present the same plan, so for the next financial year. Paragraph 5 just briefly explains, as Neil's already touched on, we're working to new standards, global internal audit standards in the UK public sector from now on. Paragraph 6 and 7, I won't dwell on this unless anyone's got any questions at the end, but it just explains our assurance levels of full, substantial, partial and little. And partial and little assurance typically will contain high importance recommendations that we'd follow up and retest and keep the committee updated as to whether we consider that the risk areas have been addressed. And then it's ultimately, we come back to the committee and say, we'd like to you to accept that we've tested this, and obviously open to questions and the scrutiny on it. Paragraph 8 explains that the sum of all the audit work feeds into Neil's annual audit report that we've just heard for 24-25. So when I did this progress fee plan in October and February last year, that fed into the report that you've just heard from with Neil. So that's why we wanted to do this second, the logical sequence. Paragraph 9 talks about high importance recommendations, and as Neil again has already touched upon, it's really pleasing to note that to date, this financial year, there's been nothing that's partial assurance or high importance recommendations, and pleasingly as well, there's no legacy ones that are still hanging around from previous financial year or years that we've had to test and we're not satisfied with. So anything historically has been cleared. That's not always the case, as you can imagine, but at the minute it's a really good news story, that is actually. Moving then on to paragraph 10, this just concludes our 24-25 close down. And the first table on paragraph 10, which unfortunately both our tables straddle 2 pages, but on pages 10 and 11, bring the members of the committee up to date on progress on completion of the 24-25 work since the last update last February. So in summary, I'm not going to dwell on it. It basically records that we've completed the 10 pieces of work we were expected to from 24-25, and most importantly, it didn't result in any high importance recommendations. So then moving on to the second table, which again, unfortunately, apologies, straddles 2 pages, pages 11 and 12. This details our 25-26 coverage to date, which as you'd expect, hopefully there's a lot of work in progress there because we're only mid-year, we're only 6 months in. So we've issued 3 draft reports. This was as at date of publication. Things have moved forward a lot since then as well, but I won't dwell on that because we're talking about the period of time that we've done the report for. But at that period of time, we'd issued 3 draft reports. We'd issued a final piece of work in respect of the National Fraud Initiative. We'd got 13 areas of work that were classified as work in progress. And we still had to commence work on a specific counter-fraud audit. And the simple reason for that is we're doing a counter-fraud risk assessment with the officers at the minute, and that would help inform that piece of work. So there's no point in starting it till we've got the documentation that will help inform it. Whilst, as I've already said, it being mid-year, you'd expect it a lot to be work in progress. Paragraph 11 does give reasons for that. And in paragraph 12, importantly, I give reasonable assurance that we're on track to deliver the work plan. But obviously, there's the usual caveats. As we've said, logically, sometimes work straddles more than one financial year. The audit year doesn't necessarily end on the 31st of March for us. Any unforeseen resourcing issues, either for ESPO or ourselves, there aren't any at the minute that I'm aware of. And a specific audit or specific audits taking longer than budgeted. I'm sure members of this committee would sooner we spent more time getting to the bottom of a particular issue if we've got an issue than we would just prioritising starting another audit. So obviously it's fully transparent. We talked to Simone and we talked to Christian and Gary about that as part of progress against plan, and then we bring that back to the committee. So, but at the minute we're largely on track. Paragraph 13 explains that the appendices on page 15 provides a lot more detail on what I've summarised today, should it be necessary. In concluding, really, the headlines as I see them for this committee are: we've completed all 24-25 work that we intended to. We're currently on track with the 25-26 plan, and there are currently no high importance recommendations to bring to the committee. So obviously I'm happy, as would Neil be, to take any questions. Thank you.
Thank you very much, Matt. Are there any questions or comments from councillors present? Or anyone, I guess? Cool. All right. Neil?
Yeah, just before you conclude, I was just wondering, in my very brief research about the makeup of the committee earlier on, about if members would like, if they're not members of audit committees of their own constituent authorities, maybe for the February meeting when we introduce the next annual plan, we might have a little bit, and some of these new governance documents around new standards, might be sensible to have a short training session.
That sounds like a great idea. I would appreciate that. I don't know if anybody else. Yeah, cool. Sounds like a good plan. Can we note that?
Did you want that on the day of the meeting, Neil? Before?
Yeah, that would be really great. Thank you very much. That's a good, excellent suggestion. I have no comments or anything on that. That sounds like really good news. So, props to all of the people involved and for our auditors. Okay, I move then that we note the progress update received and that there are no high importance recommendations within the committee's domain. Eddie, may I have a seconder for that? Ms. Butler? And all good with that? Cool. All right. Moved. Agenda item 7 is the external audit of the 24-25 financial statements report, which are pages 43 to 68 of the agenda. Gary, you're up. You are ESPO's commercial financial controller to introduce this item, and then you will be handing over to Tor Stringfellow. That's right, from Williamson Croft. Cool. All right, Gary, over to you.
Thank you, Chair. So yes, this report is going to cover the key findings from the external audit of the 24-25 financial statements, and the subcommittee will be asked to note the report. So ESPO, as a joint committee, was set up under Section 102 of the Local Government Act and isn't legally required to have an audit. However, there's obviously some significant benefits as it provides some independent assurance to stakeholders over the financial statements and supports our wider governance arrangements as well. Now, the auditors will normally confirm that the information in the financial statements give a true and fair view and are not materially wrong or may draw attention to any issues that have arisen during the course of the audit. Williamson Croft have now concluded their audit and are given the opportunity to report their findings directly to members. So at this point, we'd like to hand over to Tor Stringfellow from Williamson Croft to provide a brief overview of the audit and receive any questions.
Thanks, Gary. So I'm Tor Stringfellow, I'm the audit partner from Williamson Croft. As Gary says, we've concluded the audit work for the year ended 31st March 25. I propose just to go through sort of the audit findings report that's in the pack that's been distributed. Sort of a high level, assume that it's sort of taken as read to some extent, but go through it sort of high level and then take any questions at the end. So starting from page 49, it's probably the first page of sort of any interest within the pack after the introductions. And as Gary alluded to in there, we say our anticipated audit report is unmodified. There's no significant outstanding matters on the audit, apart from obviously when we come to sign the audit report after the accounts have been approved, then at that point we need to sort of consider going concern post balance sheet events again, but sort of on our preliminary work there's no sort of expected issues on that. It's just sort of a note that gets sort of reconsidered at final sign off. So on the next page, on page 50, going through some of the sort of detailed findings from our audit work. The trade debtors testings, first thing just to mention in there, reviewing some of the JBA debtors. We sampled some customers where the debtor balances in the accounts related to multiple individual schools within a trust, and therefore there's lots of different lines on the invoices, made it difficult to trace sort of the remittances post year end to those individual lines. But when we were completing our work, we were able to confirm sort of the majority of the balances that we sampled. So 783,000 of amounts sampled as 46,000, which we hadn't confirmed once we'd been through sort of in detail. 46,000 obviously not material to the financial statements, and the extrapolated error, which, just to explain for sort of the way we work in audit, is we sample certain transactions and balances rather than testing every single line within financial, every single number within the accounting records. And then after we've done that sample, we'd extrapolate any differences that we find, sort of say, well, worst case scenario, if the same error is found throughout the entirety of a population within the accounts, then the maximum error in that situation will be, in this case, 340,000. And if that's not material, then we don't need to do any more work on that balance, assuming that all the sort of variances that we find sort of throughout the audit or the unconfirmed balances are sort of immaterial in aggregate. So just to sort of say that the 46,000 is the amount that we didn't match out of that balance, and when we extrapolate that, 340,000 wasn't material. So that's noted in the sort of potential adjustments, the extrapolated amounts, just when we're making our assessment of what the total potential variances are, but it wasn't material, so there's no sort of further work on that area. Again, sort of on trade creditors, there's one supplier, Total Gas and Power, which has the biggest balance within trade creditors, just under 4.7 million. And when we were tracing those through to the payments post year end, there were 3 payments that added up to pretty much the same amount, so just under 4.7 million. But when we drill into those payments to see which of those payments relate to amounts pre-year end and which post year end invoice transactions, 4.4 million were pre-year end, which leaves 264,000 related to post year end. But again, when we extrapolated that amount, it was 391,000, that not being material. No sort of further work was deemed necessary to sort of confirm the balances further. Note on stock, just that when we were looking at the valuation of stock, that's at the lower of cost and net realisable value, which is basically the value that the stock can be sold for. As part of that testing, obviously we checked the cost of the items in stock to the last invoices pre-year end, and there was a minor variance of about £4,000 on sampled items of £788,000. Again, sort of an immaterial extrapolated error of 56,000, and so we're happy that the value of stock was not materially misstated on that basis. So over onto page 51, a couple more notes on the accruals. The only potential difference in the accruals was regarding our sort of audit fee and whether that was accrued, which again, this is an immaterial amount, so not something that needs to be adjusted in the end in the financial statements. Depreciation, looking at recalculating depreciation on some of the items on sort of a sample basis that within the fixed asset register. We noted a couple which have been depreciated over 8 months. Potentially they should have been depreciated over 7 when you look at the acquisition dates. It's 1,500 difference, which extrapolates to 19,000, again, immaterial. Sales cut off, viewing post year end sales transactions. We found 4 invoices that related to March 25, posted into April 25. And so we'd expect those to be sort of accrued into the gas income within the financial statements. There's a potential amount across those 4 invoices of 313,000, which actually should have been accrued back into the previous year. But again, that being immaterial, then we didn't require that to be adjusted in the financial statements. And the final note on those, just on the financial statements in general, that we reviewed the financial statements for the disclosures that are in there, and we're happy that sort of the final version, which is included in this pack, includes sort of the disclosures which are compliant with the relevant accounting standards for the Joint Committee. Page 52 then, a disclaimer sort of here where the main purpose of the audit isn't to identify all the control weaknesses within the organisation, but where things come to our attention during the audit, then we highlight those and discuss them with management. So within here, there's 3 recommendations that we've made, and the responses of management to those. The first one being physical documentation around payroll. During our payroll testing, we noted that some contracts were not signed by employee or employers. So we understand pay bandings are in place. Change of salaries and contracts should be reflected in writing and signed by both parties, just as sort of best practice in case of any sort of potential dispute. Sort of the response in the ESPO resetting the service level agreement with East Midlands Shared Service 25-26. That the commercial financial controller will be responsible for ensuring that tighter controls are put in place around contracts going forward. Second recommendation on page 53, just on credit note approvals. During our purchase cut-off testing, we found potential prepayment that should have been made. When querying this, there's 2 credit notes that have been issued because the invoice was incorrect. And reviewing those credit notes, we saw that they hadn't been physically or by email approved, and the amount being sort of 500,000, obviously that approval should have been in place. So we recommended the approval of those are put in place for, and staff are unsure, they should ask for appropriate personnel for clarity. Again, sort of the response to ESPO reviewing that, test and redesign, implement credit note adjustment process, engaging the ERP partner to review key finance system procedures 25-26 to make sure that's sort of implemented going forward. And the last point on just on the rebate testing, when we reviewed the rebates within, we found that the basis of rebate income recognition based on honesty provided from suppliers to ESPO. Contractually, the supplier has an obligation to pass the amount of income to ESPO, but obviously there's risk there of potential leakages. ESPO has implemented the use of a data specialist, Tussle, to gain visibility. And that there was an initiative in 22-23 where the discrepancies led to additional rebate of 130,000. So that's obviously something that's sort of being managed and looked into. And in terms of a recommendation, I suppose just sort of again sort of making sure that any delay or inaccuracy in supplier data submissions is minimised. I did note in the sort of internal audit work that the rebate income has been covered over the last 2 years. So again, it's something which I think that we are aware of and been managing sort of over the last few years. It's a potential risk, but in our audit testing, we didn't find anything that suggested it was misstated, and it's something which you're already sort of managing and working through. The next few pages then from page 56 are the significant risk responses. So at the start of the audit, we identify key audit risks, and that's sort of the areas where our audit work is focused on. Whilst we do sort of look at any material area in the financial statements, these are specific areas where we focus sort of more of our work. The first couple on page 56 are the presumed risks under the international standards on auditing, which are around revenue recognition and ensuring that revenue is complete in the financial statements. So there we test completeness by tracing sales from requisitions and remittances to sales invoices and through into the financial statements, looking at cut-off around year end to make sure income's in the correct period, and that revenue recognition policies are compliant with accounting standards generally. There's no sort of potential issues found there apart from what's already been discussed above. Management override of controls is the presumed risk for any entity that management could override the controls of the entity to say, put this adjustment through, put this transaction in. Again, we've looked at accounting estimates, judgments, decisions of management, journal entries, any significant transactions to sort of make sure that those are valid transactions, any judgments are sort of backed up by supporting evidence. So we're happy that there's no issues there. Page 57, accrued expenses, material accruals balances within creditors, potentially that's a judgmental area with estimations due to the nature of accrued expenses as being something in the future relating to the current year. So we obtained a list of the accruals, looked at the calculations, looked at the judgments and estimates sort of within there to make sure they were reasonable, discussed them with management, and there's no issues identified again within accruals. Related parties, transactions with the consortium members. Again, sort of obviously sort of a potential risk for any entity is transactions with related parties. And we've got direct confirmation from consortium members of transactions and balances, discussed with management and reviewed transactions throughout the financial statements for any unpresented related party transactions which have been misclassified and not found any. And we're happy that disclosures within the financial statements are compliant with the accounting standards sort of around related parties. And the last two there on page 58, defined benefit pension scheme. So where there is a defined benefit pension scheme in any entity, it's generally considered to be a potential risk because of the sort of nature of the schemes and the complexity around valuing any future liabilities, valuing the assets within the schemes. So in this case, we've reviewed the disclosures and calculations and the independent actuary reports and valuations, as well as the reporting within the accounts and the fact that it's valued at sort of zero within there because of the uncertainty, I suppose, in terms of the around the realisation of the surplus in assets in the future. We're happy that again that's within the financial statements. It's compliant with the required accounting standards. And the last thing, stock valuation, just again ensuring that that's valued at lower cost than NRV, and our testing there. We attended the stock take at the year end and as well then traced the cost of in the financial statements of a sample of the stock items to invoices pre-year end, and looked at the sales of those of those stock items after the year end to make sure they were sold for more than cost, and we're happy that those are correctly quantified and valued in the financial statements. Then next couple of pages on 59 and 60, final analytical review. So it's just an overview of the figures within the financial statements. And I know most organisations are familiar with their own financials, so in some ways it's just reporting your own numbers back to you, but it's something that we have to do as part of the audit in terms of looking to make sure the numbers at a high level make sense and that any variances sort of correlate with what we expect from our understanding of the entity and its operations. Basically, the summary there is that the variances or any movements in the year compared to the previous year are sort of what we'd expect to see based upon what we know about the entity. And in terms of the key insights, sort of on page 60, that the cash balances, although they're down compared to the previous year, there's still £12 million of cash balances at year end, which shows a strong solvency of the entity. The fixed assets have increased in the year despite them depreciating. Obviously, then it shows sort of reinvestment back into the entity. And overall, net assets have been retained at about 42.6 million, which is sort of a strong balance sheet position. So, say any movements in the year are consistent with what we'd expect, and the sort of overall position of the entity remains strong. Page 61 is the main variances in the expenditure in the year, just sort of understanding where those have gone up and down. So I'd run through those very briefly. In terms of the warehouse extension project, 2.5 million increase in expenses compared to the previous year. Just with that project having been completed in the current year, then the costs were accounted for in 24-25. And then the payroll pension costs increased in the year with sort of having an increase in the average number of employees, and conversely the agency staff costs decreased in the year, and with having more employees and less agency staff utilisation. And then page 62, summary of communication requirements, what we have to communicate to management as part of the audit. There's nothing sort of too significant in there, just that we discussed fraud, laws and regulations, late pay transactions, and satisfied that there's no sort of issues around those areas. The accounts are compliant with the accounting standards, and there's the letter of representation, which will be signed with the financial statements, confirms the going concern status of the entity, as well as the related party transactions and sort of the standard matters that get confirmed sort of each year. So there's nothing unusual again in there. Page 63 then is just a summary of the potential adjustments, which we'd already discussed sort of at the start of the document, just summarised into the impact on the financial statements of those. And then page 64 confirms our independence as auditors. There's no reason that we're aware of that we're not independent as auditors, but I would say to if anyone has any concerns at any point, to discuss them with us. And finally, the last couple of pages are just the matters, again, which showing what we have to discuss with management and those charged with government throughout the course of the audits, and where we've done that as part of our audit plan or as part of this document. And that's the end of the document. So I suppose if anyone's got any questions on anything within there, then happy to answer those now.
Sorry, can I just conclude, just do a quick summary, and then we'll take some questions. So thanks, Tor. So the auditors have issued an unmodified audit opinion for 24-25, which is the desired outcome of the audit. They've also confirmed the financial statements give a true and fair view of the state of the Joint Committee's affairs as at 31st of March 2025 and our reported profit for the year. They've also confirmed the financial statements have been properly prepared in accordance with UK generally accepted accounting practice, and no material weaknesses in internal controls have been identified, and no significant governance or compliance concerns raised. I'd just like to express my thanks to Williamson Croft in their first year of audit for how they've worked with ESPO in terms of not impacting our day-to-day activities, particularly during peak operations and peak activities of the business, while carrying out the audit and the comprehensive review they've performed in the first year of the audit. And we obviously look forward to planning next year's audit with Williamson Croft. So the committee is asked to note the external audit of the 24-25 financial statements.
Okay, thank you very much, Gary and Tor. Any questions from councillors first? Helen?
Thank you. Sorry, two questions, which are separate, I'm afraid. So on the recommendations, there were some timescales for the first two, but there weren't any for the rebate testing. So I was just wondering if you could sort of briefly tell us sort of what the timescale on the work that's being done. And then the other question was about the decrease in cash. I think it was about 3.5 million, whether you could just sort of explain what that is. Thank you.
Yeah, I'll take the rebate testing question first. So as part of the way we kind of look after rebates, really, we have a suite of controls to try and minimise kind of rebate framework leakage, because the key reliance is on that honesty of suppliers. But what we do then have is this independent platform, Tussle, which gathers some of the spend by particularly government parties and a lot of our customers that we're unable to check some of that spend against. We also hold a monthly revenue recognition meeting on rebates to ensure where we look at changes in spend by supplier and by the framework type. So if we do see kind of something drop off, then we pay much more closer attention to that. Some of the other controls are really around making sure, again, where we do see any kind of unusual activity, we do have the ability to go in and audit those as part of the contract, to go and audit those suppliers to see whether actually they have had spend with these other parties. Obviously, that's something we wouldn't want to do unless we really have to, but it is an option for us, really. So it's an ongoing process. I wouldn't say there's a particular timeline in it because it's a continuous improvement area where we are continually looking to improve those kind of leakage controls. Obviously, what we are trying to do is to really make sure that we minimise that as much as possible to maximise the revenue for frameworks. So we've done a lot of work today. Obviously, we're continuing to. It's a continuous improvement process there, really. The other question, which was
£500,000 capital.
Yeah, which was mainly to do with the warehouse extension. So we funded that out of ESPO's internal reserves last year, and so that was cost us 6.7 million over the last 2 years, which obviously affected our cash flows. We're now starting to kind of, as we go through this year, to start to build those cash flows back, making sure we've got adequate funds for the dividend payment in December.
Okay, thank you, Gary. Thank you, Helen. Any further questions? Councillor Garland?
Thank you, Chair. I had at least two. So the first one was to do with just from my understanding, really. A number of times in the report, you referred to things not being material. There was actually a value on page 50. And the value was just shy of £300,000, extrapolated to £400,000. That seems like a lot of money to me. So I just wondered kind of where you draw the line on materiality.
Yes, materiality generally for a trading entity like ESPO is calculated as a percentage of turnover. The percentage is 1%. Obviously, if anything's we bring to attention in this report anything that's over 5% of that materiality, so then obviously those can be considered sort of in aggregate and as say considered by management for any potential amendments. So we're actually looking at anything at sort of a much lower level. But in terms of materiality, the idea is that the financial statements are not failing to be true and fair and not misleading, and any decisions made on the financial statements are not potentially incorrect. And so generally sort of the amount for that is 1% of 1% of turnover in sort of an entity of this sort of size and nature.
May I ask a follow-up to that, actually, before Neil continues with his second question? 46 out of 783 is over 5%. Can you explain why that is immaterial, please?
Yeah, sorry. So it's 5% of materiality that we. So it's 1% of turnover is materiality. 5% of materiality is what we call triviality, where something's so small that we don't need to necessarily bring it to attention. So the whilst the 46,000 out of 783,000, we've tested 783,000 of items within our sample, found 46,000 that we haven't confirmed to documentation, and then we assume that that same variance is found throughout the entire population of trade debtors, which is how we then get to the £300,000 difference. And with that being immaterial, then we don't need to go and increase the sample size and to dig further into that. Balances the sort of process in terms of sampling.
Sorry, I'm going to show my ignorance here. By testing this, so you've taken a sample of £783,000 worth of existing debtors. The total existing debt is, like, are you saying that 783 is 5% of the total? Because if we're talking about turnover, then statistically, if you find 46 out of 783, when you extrapolate that out, you don't just get a maximum worst case scenario where that's 46 783ths of the total population. You're going to have a bell curve around where that is, so it could be higher, it could be lower. But if it's a base of 6%, then surely that is higher, unless I'm missing a step here.
So the total balance of trade debtors is 9.3 million. So the idea is that if we found the same amount of error that we find in our sample across the whole of that 9.3 million population, then would that be material? And in this instance, it wouldn't be. The turnover is much bigger. So the 9.3 million is the trade debtors. The turnover is 119 million.
Just try and help out, because I completely take your point. I think there's two calculations going on. So one is about looking at the sample size and materiality, and then one is grossing up to the turnover size. So I understand the maths point you're making, but I think that's the point that's not kind of coming across, the difference between the sample size and the turnover size.
Yes, so basically any number that's over materiality in the financial statements, we will review and sample transactions and balances within that number. And then within the sample size is sort of calculated where we'll look at more transactions in bigger balances and bigger numbers within the financial statements to focus our work on those. In terms of the what's considered to be material is 1% of that turnover, which would be just over $1 million. So as long as the potential error within any sample that we test and the total across all of the testing that we do is less than that £1 million, then we'd say that the financial statements are true and fair. See, in this case, it's not close to that, and if it did become close to the £1 million, then we'd obviously have to sort of review it and consider whether what the risk is that there's sort of on further sort of amounts that we've not considered and discuss it with management. But sort of generally, the opinion is that it's because it will well below that sort of amount of materiality that the accounts are true.
Okay. Jamal?
Sorry, sorry, please. So the materiality threshold, as you said, is 1% of turnover, which is just over $1 million, isn't it? So because the extrapolated errors are less than $1 million, that's why you're not suggesting that the accounts don't require amendment, because the extrapolated amount is less than the materiality threshold, which is applied to the total turnover. Is that yeah?
I hadn't realised our turnover was £100 million. Fair enough. Okay, sorry, Neil, back to you.
Thank you, Chair. So I might also be demonstrating my ignorance here. So I'm hoping my visit to ESPO at the end of October to meet the procurement team will help with that. Anyway, I'll give it a go anyway. So I have a question with regards to pages 54, possibly 55. I think it continues onto there actually as well. So there was a rebate discrepancy identified in 22-23, and that got me thinking. I was wondered, in terms of, does the scope, this might be a question actually for the guys from ESPO more than yourself actually, does the scope of the work that Optima Energy do they also look into rebate values? Are they validating that?
I don't think they are, no. But as far as I know, no, they don't.
So that'd be potentially something that Tussle would have a look at, whatever they're called. Yeah, okay, thank you. I have another one if I may, Chair. Sorry, it's again, probably need to work on my understanding of this, but perhaps you can help me fill in the gaps. So we're collecting money from members, subscribers, whatever you call them really, and then paying money to Total Gas and Power for gas. Is that right?
Yeah, we offer a energy service to customers, particularly sort of councils, which involves we've got multiple different types of service. So we have a framework offer. We also have a fully managed offer as well.
Thank you. So my question really then was, is the ESPO exposed to any kind of cash flow exposure? So obviously market volatility has been quite extreme in recent years. I just wondered, are we all on the right side of that in terms of collecting money?
Yes, there are some cash flow implications of it. not in terms of the kind of hedging strategy as such, because that's back to back really effectively. The customer takes the risk. We obviously have cash flow, particularly high cash flows during the winter period though, where we're having to pay the cost to Total Gas before we then collect that money from our customers. So there's obviously a gap there. Our working capital arrangements allow for that. So we've calculated our minimum working capital now at 6.4 million minimum requirements to make sure that we have that coverage for that over that winter period for those gaps.
Yeah, thank you. That covers it, I think.
Okay, cool. Any further questions? Councillor Bridgewood.
It don't really relate to the audit as such, I don't think, but on page 59, your income has decreased by 9%, and all your revenue streams are all going down, particularly the gas one. Is that something that you're taking into account and looking to resolve?
Sure. Yeah, it was noted there was a reduction in income, and it was mainly associated with the gas income. And so what happened last year was that gas prices in the market reduced slightly following the significant increase from the war in Ukraine. So obviously, as that gas prices, the cost of gas reduced, revenue to customers also reduced in line with that as well. So that was the main reduction. There was obviously still impact as well on the catalogue, on a catalogue area of the business where the educational supplies market is contracting. So the British Educational Suppliers Association are showing data over this year and last year that market is contracting as well. So naturally, our revenue as part of that is contracting, but we are offsetting that with growth into development areas.
Cool, thank you very much. I have one final question. With regards to the recommendations following the rebate testing, i.e. the new data procedures to keep track of our rebates, and also in light of Councillor Garland's question about whether we can do this for the gas, for the energy providers as well. How long is it going to take us to get these procedures in place so that we are fully tracking them properly?
Thanks. It's with the head of commercial at the moment in terms of they're reviewing kind of the implementation timelines of the various actions. And so obviously there's a numerous actions in this area to try and make sure we minimise that leakage of framework income as much as possible. So we've done a ton of work over the last couple of years to tighten up in this area, and we continue to do that. I haven't got any sort of specific dates here today. As I kind of mentioned earlier, it really is a continuous improvement process, and we do feel we've minimised that leakage to a really small level. As you can see, there was 130k additional rebate that we were able to identify. Again, that kind of amount is now still reducing rather than increasing, but we're getting transparency via the Tussle platform.
Just to chip in on that, just again, in terms of new members, think about rebate turnovers of £14 million. So 130k against £14 million turnover.
Yeah, I understand that the amount is relatively trivial to the overall turnover, but it's just as a data person, I'm interested in having us make sure that all of our systems are adequate, auditable, and easily trackable, because in future, when if there are poor data in future, it will be difficult to do further assessments. So it's good to just have good practice generally. So if you could let me know when you expect that to be, fully operational, that would be helpful. But without wanting to drag on in this particular meeting, I don't have any other questions. Does anybody else? No, looks like we're good. Okay, in that case, I move that the external audit of the financial statements be approved. Can I have a seconder? Councillor Bridgewood, cool. All happy? Cool. Report approved. Tor, you are welcome to stay for the remainder of the meeting if you want, but you also don't have to, so you can leave if you wish. Item 8, we now have a report on the 24-25 financial statements, which are pages 69 to 122 of your packs. Gary will present this report. Gary?
Okay, thank you, Chair. So this report sets out the 24-25 financial statements and the 24-25 annual governance statement, providing an overview of ESPO's financial performance. Its governance detailed financial statements include income, balance sheet, cash flows, and various supporting notes. And the FNA, the Finance and Audit Subcommittee, is being asked today to recommend to Management Committee to approve the annual governance statements and the 2024-25 financial statements and the dividend pool of 5.4 million for payment in December. This version of the financial accounts provided a draft and pending approval. These will be fully signed following approval and published into a final glossy version later in the year. The ETL and Edge Zone accounts are separately overseen by the ETL Board of Directors, and they will be reviewed separately at the next ETL board meeting for reference. The key points raised in the financial statements are as follows. So in 24-25, ESPO faced particular cost pressures from inflation, energy and pay increases, as well as sort of global supply chain disruptions linked to geopolitical issues. And ESPO managed to carefully manage those price increases, improve stock availability and make cost increases whilst expanding its warehouses. So as a result, we talked about earlier, so overall revenues decreased from 130.9 million last year to 119.1 million, mainly reflecting the reduced gas revenues driven by lower cost of gas supplies and the impact of the overall market contraction in the educational supplies market, although ESPO managed to increase its market share of the contracted market. For 24-25, the trading surplus reported to Management Committee was a surplus of 7.4 million, which was 0.3 million higher than budget and was a great result for ESPO overall, despite the significant financial pressures on schools and public sector customers due to funding constraints, inflation and other cost of living increases. The financial statements are different to the management accounts due to various statutory adjustments, with the main difference being the pension revaluation by the actuaries. So hence it's excluded from the way we calculate the dividend calculation. The external audit, as Tor mentioned earlier, resulted in a clean audit opinion and didn't identify any significant control weaknesses. There are some key areas of judgment within the accounts which I've highlighted in the report. These include the pension. So ESPO participates in the local government pension scheme, which is a funded defined benefit scheme administered by Leicestershire County Council. This pension liability is actuarially assessed by Hymans Robertson, and as of 31st of March 2025, the net liability recognised in the balance sheet is nil due to asset ceiling rules, despite there being a pension surplus of approximately 15.9 million. Employer contributions of the pension were 2.9 million in 2024-25, with future contributions continued to be planned, targeting the 120% funding level. The other area of potential judgment is around the value of the land and building. So ESPO's Grove Park premises were historically valued in accordance with professional guidelines by chartered surveyors. With the addition of the warehouse extension, the latest valuation report from the surveyors indicates an uplift in value of the site. And the current property value used in the 24-25 accounts is based on a certificate issued by Leicestershire County Council's principal valuer as at 31st of March 2025. ESPO's net asset position did change at the year end, reducing slightly as anticipated with the use of reserves in 24-25 to fund the warehouse extension. And there were obviously changes in variations in the debtor and creditor positions at year end, but nothing of concern. From a going concern basis, ESPO's financial position continues to remain really healthy and maintain a strong balance sheet and cash position. We had net current assets of 19.4 million at 31st of March 2025, and ongoing really high customer demand as well into this year. So as at 31st of March 2025, ESPO had no outstanding capital commitments, having completed the warehouse extension at our Grove Park facility in October 2025, and that which provided a real substantial increase in capacity and removed the need for off-site storage, providing greater resilience for ESPO. The financial performance and risks are continue to be closely monitored with scenario planning to ensure sustainability, and ESPO remains on target to deliver above the uplifted medium-term financial strategy. This strong financial position, surplus and net asset position for ESPO allows for the dividends that I'll talk to shortly, the continued build of reserves for future investment, and supports that continued working capital needs of the business I kind of articulated earlier as well. So moving on to the dividend. So each year ESPO pays a distribution back to committee members from the surplus it generates. This dividend provides a real valuable contribution towards local public services in each member's area. And after allowing for the allocations to ESPO's building reserve and general reserve, a dividend of 5.4 million is proposed, which is based on the management account surplus applied to the ESPO dividend model. The statutory adjustments, including the large movements in the pension scheme, do not impact the value of the dividend paid, and ESPO expects to make that payment to individual members in December 2025, following confirmation of the dividend at the Finance and Audit Committee and the next Management Committee. Similar to the external audit, ESPO is also not required to publish an annual governance statement. It is, however, a really useful tool to review the effectiveness of ESPO's governance arrangements, and so an updated AGS has been developed for the 24-25 year. ESPO is responsible for ensuring that the business is conducted in accordance with the law and proper standards, and that public money is safeguarded and properly accounted for and used economically, efficiently and effectively. So the AGS provides a summarised account of how ESPO's management arrangements are set up to meet these principles of good governance and how we obtain assurance that these are both effective and appropriate. The main aim of our AGS is to provide the reader with confidence that ESPO has an effective system of internal control that manages risk to a reasonable level. Obviously, we can't eliminate all risk of failure to achieve policies, aims and objectives, and therefore provides reasonable but not absolute assurance of effectiveness. The AGS framework requires ESPO to review its arrangements against its local code of corporate governance to ensure it's consistent with the 7 core principles of the framework. And the AGS has been constructed by undertaking a review of the effectiveness of the system of internal control and reviewing other forms of assurance. So a key part of the AGS is a self-assessment survey. This self-assessment survey was positive about ESPO's overall financial management and corporate governance arrangements. No individual questions identified any key weaknesses, and no significant governance concerns were raised. There were areas where smaller improvements were identified, and these have been added to the action plan to support the monitoring of progress. In terms of the internal audit service, Neil and Matt have already provided a detailed update and has already been provided in the meeting, outlining those audit opinions and assurances gained through the year. And the head of internal audit service has concluded there are no significant governance risk management or internal control failings that have come to their attention, and so substantial assurance is given to ESPO's control environment, and it's remained adequate and effective. The AGS has been reviewed by the senior management group, and no areas of significant concern have been identified in that AGS. Just in terms of other areas, so risk management, ESPO continues to ensure a really effective risk management system is in place, and the risk management policy and strategy will be reviewed and updated in 2026. And in terms of the external audit, Tor from Williamson Croft has provided a detailed update in this meeting already about the external audit opinion. And following their comprehensive audit work on the 24-25 financial statements and review of ESPO's activities, concluded that no significant audit and accounting issues have been identified, and that there were no material deficiencies in internal control. So assurance has been provided in the statement of accounts are free from material misstatement and present a true and fair view. And so ESPO continues to provide the management committee with regular updates on financial and operational performance, risk landscape and other organisational governance aspects, including on procurement, information and employees. And these are also supplemented by further reporting to the Chief Officers Group and the Subcommittee. ESPO's leadership team within ESPO also receive information on a weekly, monthly basis relating to performance and governance matters. So the draft AGS has been reviewed by the Senior Management Group. No areas of significant governance concern have been identified in the AGS during 24-25. And the review of effectiveness has been informed by both internal and external audit, and the conclusion of the review is that ESPO's financial management and corporate governance arrangements during 24-25 were sound. So in summary, the ESPO annual report and financial statements for the year ended 31st of March 2025 demonstrate a successful financial year for ESPO with a strong surplus position above the uplifted MTFS levels, despite some real challenges such as inflation, supply chain disruptions and budget pressures on schools. ESPO maintained a strong balance sheet, allowing a return of 5.4 million in dividends to member authorities, investing in infrastructure, including a warehouse extension, managing the pension liabilities prudently and continuing to provide value for money procurement services to public sector customers while adhering to robust governance and risk management practices as well. So the subcommittee is asked to recommend the approval of the annual governance statements, the financial statements and the dividend pool of 5.4 million.
Hey, cool. Thank you, Gary. That was very comprehensive. Any questions from the floor? Nope. I have no further questions or comments either. That all seems pretty clear. In that case, I move that we recommend that the Management Committee approves the 24-25 financial statements, the annual governance statement and the proposed dividend pool of £5.4 million be paid in December 2025. Do I have a seconder? Councillor Bridgewood. Cool. All in favour? Excellent. All right. Last. Item number 9 is the date of the next meeting, which is listed as the 11th of February 2026 at 10:30 a.m. All good with that? As I said previously, there are no urgent items for 10, sorry. For item 11, we will need to exclude the press and public. So I move that in accordance with the Local Government Act 1972, the public be excluded from the meeting for the remaining items because of business on the grounds that they involve the likely disclosure of exempt information. Do I have a seconder for that? Councillor Garland, thank you. Okay, no objections. Cool. Angie, can you do the thing?